morning, everyone. We are continuing with our session of hire purchase accounting. And today, we are going straight away from an example.
There was
Our question reads, an investment company purchased machines on hire purchase over a period of 3 years, paying $846 on 1st January 2003. So this 846 is our down payment. Then and further annual payments of $2,000 on 31st December 2003, 2004, 2005. The cash price of the machine was $6,000. The vendor company charging interest of 8% per annum and outstanding balances. On outstanding balances required to show the appropriate ledger accounts, the purchases books for the 3 years, and how the items will appear in the balance sheet on 31st December 2005. Depreciation of 10% per annum on the written down value to be charged. Let me hope you saw the question. Now, of course, an investment company purchased machines on hire purchase over a period of 3 years, paying. This is the down payment, and these are the installments. And you know, the installments, they were free. That is 2,000 times the 3, that's the 6,000. And we know the hire purchase price equals the down payment plus the total installments. So this is the down payment, and these are the installments, giving you 6,846. So we need to get the interest. The interest is given by the hire purchase price minus the cash price. And we got our hire purchase price from down payment plus installments minus the cash price. It was given the question. So you end up getting the total interest. So this table is really necessary, and you need to do it. It indicates the period, the installment, the interest, the principal, and outstanding balance. Whenever you are attempting this question, you need this table because it's going to guide you in doing all the rest of the other things. So, according to the table, we are seeing on 1st January 2003, the cash price of the machine, after saying this one supposed to be the cash price, 6,000. And this cash price, this is the amount of money purchased, the real cost of the machine, which is 6,000. Then the seller, the buyer, or the hire purchaser, he paid on the same date the installment. He paid the initial deposit, and this initial deposit is also called the down payment. So when you pay the initial deposit, we know very well from the previous videos that the initial deposit does not attract interest. So our interest will be 0. And of course the principal equals the installment minus the interest, which is 846. You end up, so what's the outstanding balance? The outstanding balance is always given by the cash price minus the principal, which is this. So on another day, on 31st December 2003, he paid this installment. But within this installment, there's the interest, and our interest was 8%, was 10%. So that's not was not 10%, it was 8%. 8%, that was our interest. So 8% of the 2,000 is this. And our principal equals the installment minus the interest. You end up getting this amount, and the outstanding balance remains that. Now, on 2004, the same initial deposit was given the same installment, but the installment has interest of 8%, which is this, and so you end up getting the principal. The principal, don't forget, it is the same as installment minus interest. You get this, and outstanding balance. So now, be very careful on the last. So here we are paying. This is our last time of payment, meaning we are supposed to pay the installment of this, but the interest cannot be 80% because you are supposed, this is the last time you are paying, meaning you must pay the whole outstanding balance. What does this mean? You transfer this outstanding balance here. You transfer it here. So we just bring and transfer it there. So when you transfer it, so you get the interest from installment minus the what? The principal, that's how we get the interest. After you add, when you add, this column must be equal to the higher purchase price. This column, and you are seeing it's the same as the higher purchase what? Price. When you add all this column must be equal to the total interest. And I think it's our interest was here, is here with this equal. And this must equal the cash price. And I think it has been proved. So for that case, we are going straight away from the accounts that must be prepared. There are quite a number of accounts. First of all, we have the higher interest account, higher purchase interest what? Account. We have the higher vendor account, the machinery account, the depreciation account, the cash and bank account. We also have the balance sheet. So, without wasting time, let's begin with the higher vendor account. The higher vendor account. This is an account of the seller. So, how do you prepare the higher vendor account? We are seeing on 1st January 2003, he bought a machine. You get this photo from here. The higher vendor or the seller, he sold the machine. And we know in our entry, whenever a transaction is losing credit, meaning this higher vendor was using this machine, whose cash price was 6,000. That's why we debit it. Now we credited. When we debit, we are supposed to complete our entry. So you open the machine account and you debit here, you credit here, this time around you debit. On the same date, this machine attracted interest of 846. Interest of 846. That interest, we store it here and here. So it's not supposed to be credited because this higher vendor has not yet received that interest. For that case, the interest of 846 is there. So you go to the higher purchase interest account, you complete double what? Double entry. Again, we are paying on the same date, on 1st January 2003, we saw that the higher vendor received the initial deposit, which is here on 1st January 2003, received the initial deposit of 846. But this initial deposit is either received by cash or bank. Cash or bank. What does this mean? Cash or bank. You write it here. You go to your cash and bank account to complete double entry. This HB higher vendor account. Then on the same date, he received more money of 2,000. Are you seeing here? 31st December in the same year. More money of 2,000. So that's the 2,000, but you have to complete double entry here. 2,000. Then remember, accounts must be prepared during the accounting period, most especially 1 year. So if it's 1 year, you have after a year, an accounting period, you have to balance off accounts. So we have to balance off this account. When you balance off this plus this, you got this and this. When you subtract it, our balance carried down is 4,000 and our balance BD is, it becomes as balance BD the next year. Again, they paid more money of 2,000 in 2004, which is here. So you go and complete the double entry. Even what you've done there, even this side you are supposed to do what? To complete double entry. That's why you are seeing you complete double entry and you got the balance BD of this. Then you proceed. 31st December 2004, you are having 2,000. Then you are having more 2,000. So, but you have the balance BD of 2,000. Then when you balance off the accounts, because you are entering the next credit period, you get your balance BD of 2,000. And the same applies to cash or bank. You keep on balancing off those accounts. Then on 31st December, you pay the cash or bank 2,000. Here, remove this 2,000 because you are supposed to. This higher vendor is receiving an amount. Is receiving this money from the what? From the seller. keeps on paying, and this account increases when the seller gives us no money. So that's why we got this, and after a balance off, once this account balances off, just prove yourself right. Just know you are right. Now the next thing is the higher purchase interest account. We saw very well that from the double entry of the higher vendor, this interest is supposed to be paid by the what? This interest is supposed to be paid by the higher purchase, and this high interest account, it's the liability to the buyer. This is a liability. It's a liability, and you know liability is increased by what? By crediting. That's why here we are having on 31st December 2003. This is the interest supposed to pay this interest of 160. 160, because they are not yet paid. So when you pay this interest of 160, we know very well that interest are expenses. So they are debited in the profit and what? And loss. That's why you open a profit and loss account. This is what? 160, because interest are what? Expenses. Interest in our income statement, we look at the expenses at the end of the year. We go in our profit and loss, we debit. Then you balance off. Then for the next period, when you balance off, that's what you get. For the next period, you pay the more interest, which is this. And we know very well, don't forget computable interest. At the end of the year, we treat interest as expenses. In the balance sheet, they are expenses. So you also put it there and you balance off your accounts very well. So same approach. And this interest account, you must make sure that it's also balanced off. It's solved. Once it does not balance off, it's solved, just know you are wrong. Now another account we've not looked at is depreciation. The profit and loss, we've talked about it, we've talked about the cash and the bank. We've also talked about the depreciation account. So now the last account we're going to talk about is the depreciation account. This is the depreciation what? Account. So for this case, this is the depreciation. They said in our question, they said show the appropriate year accounts. We've seen them in the years, and depreciation of 10% per annum on written down value. They said depreciation of 10% on written down value. Don't forget written down value. It's the same as net book value. And net book value equals to cost minus estimated depreciation. So our cost in the first year, our cost was this. And the first year there was no depreciation, meaning that estimated depreciation is 0. That's why we ended up getting the 6,000. And the net book value in the first year. And the second year, the cost of the machine remains the same. The accumulated depreciation, of course, we get the accumulated depreciation. They said 10% of this, then the net book value equals the cost minus depreciation is this. Then the cost remains the same the next year, trading year. The accumulated depreciation, we know the total depreciation is 6,000 minus the depreciation of year 540. Then again, in 2005, the depreciation, the cost remains the same. The accumulated depreciation, we get this minus 10% of this, because it's the net book what? Value, the outstanding balance. So you end up getting 1626 as the what? So the total depreciation is 336. So that's the depreciation. And we know very well, depreciation is the liability, the higher what? The seller is the liability, the accumulated depreciation. That's why we debited it, and we went and we created it and debited the profit and loss account. Debit, credit the profit and loss account. Credit the profit and loss account, because it's an expense at the end of the year. So that is all about the depreciation. So if you don't ask, if you have any questions, you can contact me on 077 17 55 239 and 0759 10 9 40 792. And don't forget to subscribe to Langton Academic Solutions in case there are some new videos that you may need. So otherwise, for now we are ending it at that. May God bless you.